Okay, welcome to session number 2 of the fall 2019 Connect to Industry webinar series. Our guest speaker today is Mr. Ryan Davis with AgChoice Farm Credit. Ryan is the Director of Credit Administration, and he's going to be talking with you today about the 5 C's of credit and the factors that affect both personal and business credit worthiness, and tying it all back to SAE. So Ryan, take it away. They're all yours.
All right. Well, thank you, John. Appreciate the opportunity to speak to you all today. I'm excited in particular to address your group because of the strong focus here at AgChoice on ag education, but also some of my personal experience related to education. My wife has worked for a elementary special education teacher for over 11 years. So thank you for all that you do, those that are in education. And I hope for those of you that were in the classroom today, it was a good day for you. And if not, hopefully we can give you a positive end to the day here, talking about some financial topics. So I'll just give you a little bit of my background here. I was born in Pennsylvania, the western part of the state, and I've settled here in central Pennsylvania after attending school at Messiah College locally here. And then I also completed my MBA through Penn State. I spent over 15 years in various aspects of banking, from retail to student lending to commercial banking, and now in ag finance. As John mentioned, I am the Director of Credit Administration here at AgChoice. And the kind of tagline for my role here is to establish and promote a positive credit culture through approvals, training, and procedures. And so what that means on a daily basis is helping to chair our credit committee, giving a lot of credit training to our team members at our association, working with policies and procedures, and just some overall leadership responsibilities here at AgChoice. So today I'd like to talk to you, just give you a brief background on AgChoice and our footprint, who we serve, what we do on a daily basis. I'd like to also give you an overview of some of the educational materials that we may be able to provide to your classroom. So part of that is a personal finance 101 training, and then a credit 101 training. And so I'll give you abbreviated versions of those. They won't be exactly what you might see in the classroom, but I'll just give you a good representation of that. And then we'll wrap up by talking about some resources available to educators. I'll pause about 3 times along the way here to ask for questions and check in with John just to see if there are any questions sitting out there in the queue. So just a little bit about AgChoice. At Farm Credit, we lend money to those in agriculture and rural communities. AgChoice is part of the nationwide farm credit system that was established more than 100 years ago. We are a cooperative structure, which means that those who borrow money for us, mostly farmers, are also our owners. So we're very dedicated to supporting the future of agriculture in Pennsylvania, especially since most of our board members are farmers. We do have a local staff and a lot of folks within our team that have a farming background. We serve over 10,000 farmers and agribusinesses through our 10 branch offices across the state. Our customers include operations that are involved in dairy, timber, fruit, beef, poultry, and some of those that simply want to live in the country. We cover 52 counties in Pennsylvania and about 4 counties in West Virginia. And the southeastern part of Pennsylvania, the little section you see missing in the map there, is covered by our sister association, Mid-Atlantic Farm Credit. We are primarily a lender, and we don't have retail banking operations. So that means we don't take deposits. So you can't get a checking or savings account with Farm Credit. And then one last thing I wanted to highlight that's unique about Farm Credit is the concept of patronage. And patronage is very similar to a dividend. And that's, in essence, something that we return to our customers. We return a portion of the interest paid each year to our customers. And effectively, that reduces their borrowing costs with us. So we retain the amount that we need for our capital ratios, and then we distribute the rest. We distributed a record amount of patronage last year of roughly 40% of the interest that our borrowers paid in 2018. That was distributed early in 2019. You'll see the graph there of the amount of patronage we paid over the last 8 or 10 years there. The 5-year average, and that actually doesn't include this past year, is just a little over 25%. So just as an example, if somebody had an interest rate of 6% on their loan, after patronage of about 25%, that would lower their effective interest rate to 4.5%. So it does have a very significant impact on their borrowing. So I'll move from there into the Personal Finance 101 section, and just some overall, just general guidelines for managing your finances. So the first concept here is the importance of building a budget. So budgeting is important for everyone. It really helps you to determine where your money is going, where you can save money, how long it's going to take you to save. Some questions that may be more personal, like, can I afford this new house or this new project that I want to undertake? And maybe even some benchmarking questions. So how am I doing relative to last year's budget? Some steps that you can take when you're thinking about your budget. The number one is just to know your income. So if you are a wage earner, that may be pretty straightforward, but if you are a business owner, you do need to track your income a little more closely. You want to identify your fixed expenses, so things that generally probably shouldn't change, like your taxes, housing expenses, debt payments. You also want to look at your variable expenses, things like food, recreation, transportation, clothing, some of those things that you may be able to manage up or down based on how your income is going for the year. It's also important to prioritize what is important and what isn't. And I think this is one of the most important parts about budgeting. Because your priorities determine your actions, and your actions are going to determine whether or not you're going to be able to meet your goals. It's also important to follow your spending and review it over time. So don't just create a budget and put it on the shelf, but track your spending over time. And compare your budget. Look at your budget to your actual spending and see how you're performing. If you're a little bit behind on your budget, then maybe that's time to start adjusting some of those variable expenses. It's also important to think about some of the goals that you have or benchmarks that you want to set for yourself. So as it relates to savings, savings is very important. It allows you to buy something in the future that you might not have money for today. And a few savings goals that might be good to strive for would be to save at least 10% of your income. And a good suggestion related to that is to save a portion right away when you receive a paycheck, so it isn't as easy for you to spend it. Also, an idea would be to build an emergency savings account of 4 to 8 months of living expenses. You may have heard the expression, life happens. Things are going to happen that you just can't plan for. So if you have that emergency fund set up, you aren't scrambling to figure out what to do. As far as spending and debt, we all have certain expenses and we need to spend some money. But when you're making a purchase, it's helpful to think about whether it's a want or whether it's a need. And while it's best to only spend on things that you have money for today, having a credit card or a loan can be helpful to you to purchase things that you need for your life. And so when you're thinking about that, you want to limit some of your consumer debt payments, like your credit cards, car payments, those types of aspects, as much as possible, certainly less than 10% of your gross monthly income. And you want to try to keep all of your debt payments, like your consumer credit, house, all those aspects, to less than 35% of your gross monthly income. Now, another piece of managing your finances is your credit score. And I think there's a lot of mystery surrounding credit score. What goes into it? What makes up your credit score? What has an impact and what doesn't? So we'll talk a little bit about that today here as well, to try to frame that up. So what is a credit score? A credit score is a numerical expression based on statistical analysis of a person's credit files, and that represents the credit worthiness of that person. It's an indication of whether or not essentially you're going to be able to pay your debts. The credit report includes information sourced from the 3 major credit bureaus, which are Experian, Equifax, and TransUnion. And they basically are a snapshot of your payment history on accounts and how you've managed your credit. Credit score really has a lot of impact on a lot of aspects of life. It could influence loan, insurance approval, interest rates, loan terms, A lot of employers actually run your credit report to see how you manage your personal finances. Could even have an impact with a landlord. If you're looking to rent a location, they may want to check to make sure that you're going to pay them on time. So just a few missteps, a few missed payments can have a pretty big impact on your credit score. And your credit score is a snapshot of the most recent 7 years of history. So you can make or break your credit report pretty quickly, and it could take up to 7 years for a negative item to fall off your credit report. So what's in your credit score? What makes up that score? This breakdown comes directly from Fair Isaac Corporation. You may have heard the term FICO or your FICO credit score. That's Fair Isaac Corporation that generates that. They generate the general model that drives all the major credit bureaus that I just mentioned. So the top factor you can see there that impacts your credit score is your payment history, 35% of your score. So whether you're paying your bills on time or not. The second aspect is the amounts owed. So that's not only balances owed, but also balances relative to limits. So if you have a credit card with a $10,000 limit on it, and you've borrowed $9,000 of that $10,000, that's a pretty high utilization rate, and that will probably negatively impact your score. Whereas if you only had $1,000 borrowed on that credit card, it may not have much of an impact on your credit score. Length of credit history also has an impact. So how long you've had credit and how long you've been paying back on your obligations, that has an impact. New credit can have some impact as well, especially if you're taking out a lot of new credit at one time. And then lastly, the types of credit used can have an impact. So if you have limited history, like you only have one type of debt, like you only have an auto loan on your credit report, it could limit the upside of your credit report. It may not be able to get quite as high as if you had a good mix of different types of credit, like a credit card, a mortgage, student loan, and then some of those different types of debt. So that's what goes into your actual credit score. Now, your credit score can range anywhere from a score of 300 to 850. And you'll see that's sourced directly from FICO.com, but this is a distribution of nationwide what credit scores look like. And so as you can see, a credit score over 700 is generally considered good, and only about 55% of the population has a credit score over 700. And just to give you an idea of how that translates to an actual delinquent loan obligation, this is a distribution of delinquencies based on credit score. So as you can see, if you have a credit score of 700 or above, you have a pretty low delinquency rate, 5% or less probably. But even as you move below a credit score of 700, that potential delinquency rate triples and continues to go up as the credit scores go down. So there is a pretty strong tie to this FICO credit score model and actual credit performance. And that's why most lenders rely pretty heavily on that model. Now, to give you an idea of how this actually ties practically to what it could cost you as a borrower, here's just a kind of a generic example of two situations here. Two different borrowers trying to borrow $10,000, one with a credit score of 500 and one with a credit score of 775. And just an idea of what kind of difference you may see in your loan rate. So as you can see, the person with a 500 credit score has an interest rate of 9% on their loan, and the person with the 775 credit score has an interest rate of 5%. Same term of years, 5-year term, and monthly payment doesn't seem that different. It's only about $20 different per month. But over the life of that loan, the person with the lower credit score would pay over $1,100 more on that $10,000 loan. So 11% more in the cost of their loan over those 5 years based on the interest rate increase tied to their credit score. So having a low credit score could have a pretty significant impact, especially when you start thinking about a much larger loan, like a mortgage or something like that. So lastly, as far as it relates to credit, just a few tips on how to manage your credit score. Number one, most importantly, pay your bills on time. If you're paying your minimum monthly payment each month and you're paying it on time, that's a positive check mark on your credit report each month, and that's going to positively impact your score. Number two, communicate with your creditors. Certainly, if you run into some sort of financial difficulty, if you are reaching out to your creditor and you're communicating with them, they can help you. They can help you potentially restructure debt or come up with some sort of compromise with you. And that's going to maintain a stronger credit score over time. Third, keep your balances low on revolving debt. We already talked a little bit about your loan utilization rate. So you don't want to be running your credit cards right up to their limit or your lines of credit right up to their limit, because that will have a negative impact on your credit score. You do want to limit your amount of new credit as well. So don't try to take out a lot of new credit at one time. Don't apply for and open a bunch of new credit cards at one time. You do want to try to maintain some long-term relationships. A lot of times I recommend trying to keep one credit card for a longer period of time, even if you do transition some other credit cards based on some of the benefits that they offer. If you can keep one in place, that does show a long-term history with one lender. Fifth, having credit cards and managing them well does boost your score. So a lot of times when folks don't have credit, I do recommend trying to get a credit card, even if it's a small limit, and just trying to consistently make payments on that over time. One of the easiest ways to do that would be to, for example, just pay for gas for a vehicle if you have a vehicle each month with your credit card, and then pay it off every month. So you probably have a pretty fixed expense that you're used to paying already on time, and just get that paid off every month, and that'll start to build your credit pretty quickly. If you do have a small collection account, like a medical collection or something that comes up, and you may even dispute that collection account, it is important to pay that off first, and then try to fight against that if you believe it's an incorrect item on your credit report. You can severely damage your credit in a short period of time, especially if you leave collection accounts out there for a longer period of time. Last, and probably most important, I would recommend checking your credit report annually. You can do that for free through the website that I have listed there. It's www.annualcreditreport.com. It's important to follow that specific link because there are a few other links out there that are very similar to that one that do charge you for pulling the credit report. That is actually a federal mandate, so you do have a right to a copy of your credit report each year from all three of the major credit bureaus through that site. Now, that does not include your credit score, but it does include your credit report, so you can verify all of the open accounts that are listed, your performance history with those accounts, and those types of aspects. There are some other websites that you can usually check your credit score for free. Some banks and some credit card companies do that for you. There are some resources available there. So at this point, I will pause for some questions, just to see if there's any questions out there specifically related to budgeting or credit scores.
So Ryan, we did have a question in the Q&A box, as well as an attendee that was actually not able to attend that reached out to me ahead of time. So I'll start with that one. Carol Fay, who is our state SAE specialist, reached out to me in advance and asked if I could relay to you the question. The record keeping on finances for Supervised Agricultural Experience projects that students do as a high schooler, can that have any impact or bearing on their ability to apply for and successfully get a loan at a decent interest rate when they do turn 18 and qualify for loan application?
Yeah, that's a great question. So certainly that type of experience, unless you've actually borrowed from a lender, that's not going to impact something like your credit score, as we talked about. That's probably not a reportable item. However, that doesn't mean it's not important. I would say there's a couple of aspects that I would see that coming into play as an important factor. So number one, really just developing skills for strong record keeping, extremely important as you start to build lending relationships with financial institutions, so that you can build strong record keeping skills through those projects. I think also developing a strong business plan can be very important. So if you do want to start your own business in the future and start to borrow related to that business. If you've already started to build some of those skills and build a strong business plan, that is something that a lender would certainly look at favorably. And the last thing is, if you're keeping historical records, if you have a project that eventually develops into an enterprise that you want to actually run as more of a career, that gives us even a longer history to look at in terms of production or financial management over time. So even if it's a small operation initially for a project and it becomes a larger operation, having that history developed would give us more confidence in relying on projections for the future if you were going to expand that operation or something like that.
Okay, thank you. Tom Ritchie asked in the Q&A box a little bit ago about this PowerPoint. Would you be willing to share this PowerPoint with these teachers to either refer back to or perhaps even use with their students?
Yes, absolutely.
Okay.
So we'll talk a little bit more later about some of the resources available here, but one of the resources is actually having an AgChoice staff member come out to your classroom and give a very similar presentation. So that is something that we love to do. We have folks across the footprint here in Pennsylvania that'd be willing to do that. So we could get somebody out to do that presentation, or certainly provide some of the resources here as well.
Okay, one more question submitted through the Q&A box from Sarah Beth Alderfer up at Athens High School. What are some suggestions that you have to share with students who don't think credit will impact them as a means to demonstrate to them that it will impact their future?
Yeah, it's a great question. And I think that it's definitely an opportunity area for a lot of high school programs to talk about it more. So I really appreciate that question. So I think just highlighting some of the things that we talked about here a few slides back, the cost of a low score, how that could impact borrowing costs is a big thing I would highlight, certainly. And then also some of the credit score influences here in this orange box. If you do want to go to college and you don't have a parent that's willing to provide for a loan for you or provide funds for you, trying to borrow funds, you need to have a credit score and have a positive credit history to try to do that. Insurance approval. There are more and more insurance companies that even for your car insurance are pulling a credit score, and they've tied that analysis closely enough to credit performance to driving history, actually, to impact your insurance rate. So you could be paying more for your car insurance just based on a poor credit score. Even employment or ability to rent, we talked a little bit about your living situation could actually be impacted by your credit score. So since the financial model is so strong and so strongly tied to borrower behavior, more and more industries are utilizing your credit score or your credit history to impact their decisions that they make. So so I think there are a lot of ties that you can make to a lot of different areas of life that would be able to be highlighted with students. So very good question.
No more at this time. Keep them coming though. These are great.
Yeah, very good questions. All right, thanks, John. Okay, we'll move on to talk a little bit about Credit 101. So we'll talk a little bit about loans first, and then we'll talk about some of the different types of loans that AgChoice offers. So just as a level set or kind of a basic framework, a loan is when a bank or a person lets you use their money to buy something, and you have to agree to pay that money back, obviously, and plus a fee for borrowing the money, which is interest. And at AgChoice here, we provide loans for a variety of needs for rural and agricultural customers. These include farms and farm-related loans. So they could be for machinery, equipment, livestock. Could be lines of credit, bare land tract loans, timberland, rural homes, building lots, and more. The major segments in our loan portfolio would include, we have about 25% of our loan volume to part-time farmers, so those that have some sort of other source of income but are doing some sort of farming. We have about 19% of our loan volume to the dairy industry, and then over 10% of our loan volume is in the forest products industry as well. So our loan portfolio does, I think, pretty well represents the agricultural industry in Pennsylvania. So just to talk a little bit about some of the different loan types and just again, a basic understanding of some of the different loan types that we would work with. The first would be residential loans. Residential loans tend to be single family homes on limited acreage, and they may have a loan term up to 30 years. The risk is typically perceived to be fairly low on these loans, since they a lot of times are W-2 wage earners, so they are seen as having a stable source of income. And sometimes they're referred to as secondary mortgage market loans because they can be resold in a secondary market. Decisions are typically made on a ratio basis, like payments as a percent of income, like a debt to income ratio, and typically based on a good credit score. Part-time farm loans are similar. They don't necessarily qualify for the secondary mortgage markets, but they are typically W-2 wage income driven as well. Again, they may have a better rate because the risk perception is lower with W-2 wages. And again, the primary decision tool is ratios and credit scores. Dealer credit, these are loans that tend to be originated and financed at the dealer or the point of purchase. We do, at AgChoice here, we do have a Farm Credit Express program where we partner with ag equipment dealers to be able to finance that equipment. These types of programs are typically driven by volume. So there are a lot of transactions at a low rate, limited information collected, and fast decisions. The volume of the transactions is used basically to reduce some of the risk associated with these loans. There's typically not really much relationship with the lender, and the credit score is the primary decision tool. So a borrower may go into an equipment dealer and get a loan with AgChoice, but they may never really interact with AgChoice because they're primarily just trying to get that piece of equipment financed. Now, commercial loans is probably the majority of what we do here, and these tend to be business loans where the business has a lot of contact and a lot of a relationship with the lender. The lenders tend to be more of a consultative advisor, but we certainly don't make any decisions in that borrower's business. They do require a higher rate typically to justify the relationship because we are traveling to that borrower's business quite a bit, interacting with them quite a bit, a lot of documentation surrounding these types of loans. And typically it requires more analysis and information to make sound decisions. And then lastly, lines of credit. This is kind of a subset of commercial loans. These are intended to bridge the gap between an investment and a harvest or a sale. So probably one of the best examples would be for a crop farmer. They could have a line of credit that they could use to purchase their inputs like their seed, their fertilizer, all those aspects that they need to get the crop in the ground at the beginning of the year. And then whenever that crop is harvested at the end of the year, they would use the funds that they receive from that crop to pay that line of credit back down to zero. So that lines of credit are typically used to pay some of those operating expenses, that would be typically paid back in the normal business cycle, whether that's a yearly business cycle or a monthly business cycle. They're typically not used for capital purchases like equipment or real estate or those types of purchases. And with lines of credit, we typically do recommend that you pay those down as often as possible whenever you have excess cash. That does save you on interest costs. It can improve your credit score, based on, again, that utilization rate that we talked about earlier. And then you do have that cash essentially available to you on that line of credit in the future if needed. So again, I'll just pause there for some questions on loans or types of credit if there are any.
I have none at this time.
Okay, great. Well, we'll move on here to then the 5 C's of credit. And the 5 C's of credit really is the foundation for making sound and constructive loans. So it's essentially our framework here at AgChoice for making a sound loan decision. The 5 C's of credit aren't a unique farm credit principle. You would find the 5 C's of credit at a lot of financial institutions, but what I'll discuss here is probably more of the farm credit twist, we'll say. But when we're thinking about making a sound loan to one of our borrowers, we were looking for somebody, an individual or an entity that's high character, somebody that has credible business practices in an amount and under terms and conditions that reasonably assure that they can pay that loan. and they should have sufficient equity and or collateral to protect us against loss. And so the first of the 5 C's of credit relates to that character aspect. So what do you think of when you discuss someone's character? A lot of times people will say they do what they say they're going to do, or they think about their past experience with that person. So when you're looking at a potential borrower's character, you need to evaluate their honesty, integrity, which a lot of times we can determine from reviewing their performance under other loans or credit cards. You can also look at their management ability, compare them to their peers with respect to financial, production, human resources, marketing, strategic management, some of those key aspects of their business. So we measure character a lot of times through some of those more financial aspects, like a credit report or tax return or a balance sheet. However, there are some other aspects to character. Some of the word on the street about a borrower, if they have a bad reputation in the community, could be related to even a visual inspection of the farm. If it's not well kept, or if there are certain aspects that cause concern, that could point back to a character issue or a management issue. But character really is the most important factor in properly assessing overall credit risk. You do see cases where somebody of strong character continues to make payments on their loan, even when all of the financial indicators might say that they shouldn't be able to do that. So character really has a big impact on whether we trust a borrower long term. And I personally think that that's even more important in the farming community. It is a very close-knit community, so word travels fast, and so if your character is called into question, it could have a serious impact on your ability to borrow long term. Second of the C's is capital, and capital refers to the financial strength and the structure of a borrower's balance sheet. This is measured by their net worth and their liquidity. So basically, you want to make sure that the borrower's capital position has the necessary financial support in case they run into any adversity. If they have a weak capital position, that greatly increases the likelihood that the business is not going to survive in an economic or an industry downturn, or under some sort of other adverse condition. It's really the first line of defense if somebody's not generating positive cash flow in their business. And so when you're looking at somebody's balance sheet and evaluating it, you want to look at their net worth and, has it continued to grow over time through earnings that's been consistent over time? There could be changes in net worth due to a gift from family, or some sort of capital appreciation. Maybe their real estate has continued to grow in value, and you need to think about those factors. You also want to look at their liquidity, like how much cash are they keeping on hand, or other kind of liquid collateral that they could use as a backstop if they're having trouble making other payments. And then you want to look at those trends over time. So you want to see net worth that's increasing over time, hopefully, and building liquidity or working capital over time. The next of the C's is capacity, and that has to do with repayment ability. And this is the most important of the financial metrics. I know we talked about character, and that's the most important overall of the 5 C's, but this is the most important financial metric. And this has to do with the business's profitability and its ability to meet all of its obligations. And so the business should have enough earnings to meet all those obligations, but also to provide some capital for growth for the future, be able to make some necessary capital expenditures over time, pay for some of the living expenses of the owners, and then also have some cushion for adversity as well. So we don't want to see somebody who has only enough repayment ability to meet their obligations, and that's it. We want to see some sort of cushion against adversity. And we would consider ourselves a cash flow lender, meaning that we focus on the cash flow that the business can generate to succeed. That's really more of a long-term strategy to ensure that the business can remain viable and successful over time. And this really ties into AgChoice's shared purpose statement, which is inspiring growth in our families, businesses, and rural communities. So we want to look towards long-term growth and long-term success for all of our borrowers. The next C is collateral, which has to do with the security for your loan. And As we talked about, in case of adversity, the lender's first line of defense is the borrower's repayment ability. The next would be the borrower's capital or net worth. And really the last resort is collateral. So the last thing that we ever want to do is collect somebody's collateral or foreclose on their property. It's really more of an insurance policy for the lender. We do want to make sure that when we take collateral, that the expected useful life of the collateral does not exceed the loan term. For example, you wouldn't use farm equipment that has a useful life of 10 years to secure a loan with a repayment term of 20 years, because that collateral would be worth, next to nothing for the second half of that loan. You probably also wouldn't want to use crops planted in the field to secure a 5-year tractor loan, because that crop's going to be pretty much worthless after maybe even just 6 months. You do need to make sure that the collateral matches up with the term of the loan. Some other aspects to think about with collateral is the liquidity of the collateral, and that means how quickly could we gain access to funds if we had to liquidate that collateral or sell that collateral. So a piece of real estate may take a while to sell. A tractor or something like that may be pretty quickly sold to a dealer. We also need to think about specialization. So if we took a cotton gin as collateral, for example, in Pennsylvania, that may not be the best piece of collateral since there's not much, if any, cotton industry in Pennsylvania. We also have to think about environmental concerns, especially with real estate. So if you look at a property that you might be considering to take as collateral and there's sludge runoff into a local creek, or there's underground tanks of some sort that are leaking, that collateral is probably not worth near as much as we may think it is. So it could cause some concerns, not only from a value standpoint, but also potentially from a public relations standpoint. But again, collateral really is viewed as more of an insurance policy and not as a primary source of repayment for us. The last of the C's is loan conditions. And this really has to do with the terms upon which the loan will be made. So we use loan conditions to help manage the risk in the credit. So you can manage things like the loan amount as it relates to the collateral value. You could manage the repayment period to match up to a certain event. So if the borrower has a contract for production of a certain asset that's 10 years, maybe you don't want to set the loan term up beyond that 10 years. Because you're not positive that they may have cash flow beyond those 10 years. You could be tied to the purpose of the loan. Again, if it's, say, a real estate purchase, you may not want to tie that to a piece of equipment or something like that. We can also set loan covenants, such as financial reporting requirements. So the borrower may have to provide financial statements or balance sheets on a yearly basis to us, or maintain certain ratios on an annual basis. They may have to maintain insurance, whether that be on a piece of collateral or maybe even a life insurance policy on one of the owners if they're a key manager in the business. So we really custom tailor loan conditions to the situation and to the type of borrower that we're dealing with. The bottom line is there's always risk in lending money. So we want to properly analyze the credit, assess the level of risk, and manage that risk so that we can make a sound and constructive loan. And we can really build a solid foundation for making high quality lending decisions by using these 5 C's of credit, making sure that we've addressed all of them well. So I'll pause again here for any questions that anyone may have on the 5 C's of credit, and then I'll just be wrapping up with some of the resources that we have available.
Okay, Ryan, we do have a question from Sarah Beth in Athens again. In regards to character, how are you able to judge this as a lender? Is there a certain form that lenders fill out to record some of these characteristics? She was trying to figure out an activity that she could do with her students relating to whether or not they would be a good candidate for a credit or a loan, which I love that. I love the concept there, and hope she follows through on that. Any advice for Sarah Beth?
Yeah, great question. And I think that is a great activity. So, as far as an activity, I mean, I think you could focus in on, certainly some of the aspects that we talked about. So, you could list certain characteristics of a borrower, start talking about somebody who has a great production history, is well liked in the community, is consistently meeting all of their obligations. Maybe they borrow or they pay a local farmer for feed, and then they interact with another borrower or another person in the community to borrow money for a tractor or something like that. You could set up some different scenarios that are kind of less tangible qualities, but important qualities that tie into character, and maybe contrast them against somebody who maybe have less character. You could also look at some of the financial metrics to try to judge that. So you could look at somebody's production history over time, or somebody's income over time, and kind of tie that back to this management ability concept, and show them as a strong manager and potentially somebody of strong character. I think you could go a few different routes with that. And I guess the way that we look at it internally is, we have loan officers that are out in the field, and they a lot of times are trying to judge character based on some of those less tangible items, trying to assess the visuals of the property, the type of records that they're getting from the customer, reputation in the community. Where our internal staff, we have an underwriting team of credit analysts. They may be looking more at the financial metrics. So they may be looking at the credit bureau report to see how that's trended over time, how their scores looked over time, or how they've paid other obligations. They look more at their financial metrics that I mentioned, like the income statement or the balance sheet, and how those may compare to, say if it's a dairy customer, how it compares to other dairies in the industry. So they would be looking more at the financial metrics that may be a closer tie to character. So you could approach it from a couple different angles. You could look at it more from the intangible category and more of a loan officer perspective, or you could look at it from more of a tangible side of things and looking at financial metrics. So does that answer your question, Sarah Beth?
She said yes, and she loved the response. Thank you.
Okay, great.
No more questions at this point.
Okay. All right. Well, thanks, John. Well, press on here just through final portion here, which is some of the resources that we have available to educators. So there's basically two main aspects that we could offer to you in your classroom. I already talked a little bit about number 2 up there, the classroom visit. We could set up a classroom visit from an AgChoice staff member to provide some of the basic personal finance concepts, some of which I already shared today. And they could also share about agricultural loans and what that may look like. We also have an online module series called AgBiz Basics, which is focused on finance and business management training. And we could do either one or even both of these activities in a school year if they would apply well to your classroom. And so I'll show you a little bit about what this AgBiz Basics course looks like. The teacher subscription would include 4 online modules to watch in a classroom setting. There's some printable quizzes with answer keys, and there's some additional resources that you can download. And the coursework basically follows a case study through someone's quest to start a farming operation. And so you can see a little visual there of what the module looks like. And I have another screenshot here in a minute to show you. The 4 modules, module 1 is side by side with your lender, planning, goal setting, and financial documentation. Module 2 is do you cash flow? So that would be the business side of production planning. Module 3 would be what are you worth financially? So business and personal balance sheet creation. Module 4 is did you make a profit? So focusing then on the income statement. And these modules were created by Dr. Dave Cole. He's a professor emeritus with Virginia Tech, and we do work with him quite a bit, and he's well known in the ag finance field, I'll say, in particular for some of his education that he's done in that community. So another just look at what the module looks like there. This is just kind of a visual of that. Here's some images of some of the workbook exercises that we have. So there's a lender preparation checklist, some of the cash flow sheets that some of the students could put together, but those are available to download in Excel format, so you can work through those and edit those. And then we do also have multiple choice tests which would be downloadable to use in the classroom. And they do include the answer keys as well for the tests. So who doesn't love a great test, right? So if you are interested in any of these resources, I would encourage you to reach out to Rachel Sadazan. She's the AgChoice Knowledge Center Director. Her email address is there on the screen. I think I can probably add that to the chat here as well, just in case folks want that. And there's her direct phone extension as well. The AgBiz Basics modules and the classroom visits are all free to schools. So AgChoice actually pays the $150 teacher subscription fee for the AgBiz Basics modules. So that is something, again, AgChoice is extremely passionate about ag education. And so these are just, I think, some great resources that we can provide to you that hopefully would tie in well to some of the SAEs that John and I have discussed a little bit here. And just, I think, provide a good, solid framework for anybody who's interested in ag and interested in ag finance as well. So that is all I have. I do have my contact information there as well. I'll probably leave Rachel's back up there, but any final questions that anybody has from the group there before I turn it back over to John?
Sarah Beth in Athens, once again, do you have to be in the AgChoice Farm Credits region to use this resource? For example, if you're in the Mid-Atlantic credit region, is this open to everybody, whether or not you're in AgChoice's territory or not?
Yeah, so we partner quite a bit with Mid-Atlantic Farm Credit as well for a lot of the resources we provide and offer. So I would say you just start by reaching out to Rachel, let her know that we connected through this webinar, and I'm sure we could get somebody in touch with you to try to get something set up here for these resources.
And Sarah Beth would just like to let you know that this is awesome! Exclamation point.
All right. Well, thank you very much. I really appreciate the opportunity to talk with you all, and certainly hope this is helpful. And as you guys work through your projects, I think you guys are all doing some great work with students and building a strong foundation for Pennsylvania agriculture.
Okay. Before we stop recording here, does anybody have any final questions for Ryan about any of the content covered in his presentation or the resources that he just went over as available to you? Okay, I'm not seeing any. So before I let you all go, I would just like to take this opportunity to cover some of the standards that Ryan touched upon here, AF&R standards. And you should see them appear now. These are directly from the Council's National AF&R standards. Record keeping, obviously, budgets, ABS 03, again, cash budgets, credit budgets, developing a business plan, and again, using credit appropriately to reach business goals. Were all things that Ryan covered. The FFA connection, obviously, we have a couple career development events that students can participate in, and you can help prepare them for that utilizes some of the content and resources that Ryan shared with us today. The Farm Business Management CDE, the Marketing Plan CDE, as well as the Ag Sales CDE. And the preparation for these events obviously utilizes a lot of what Ryan covered. And SAE, Ryan touched on and answered questions from Carol about record keeping, creating a business plan, which is a critical component to some of the more entrepreneurial and ownership type SAE projects. And of course, if you have a student who would like to pursue perhaps a career in the ag business and credit lending world, I'm sure AgChoice would be more than willing to set up some type of job shadowing experience that a student could also keep as an SAE project as well. Okay, and I'm going to also take this opportunity to put in a plug for the next and final Connect to Industry Fall 2019 series. Join us again on December 18th, same time on Zoom, to hear from Crystal Snyder with Penn State Extension that will be covering the needs of the commercial greenhouse industry as it relates to the ever-emerging and changing industrial hemp industry. So again, it's December 18th, Wednesday from 3:30 to 4:30 p.m. Eastern Standard Time. Hopefully we will see you there. Okay, I'm going to double check. Amy has no questions. Tom also chimed in that those were great resources. Anybody have any last questions or comments for Ryan? Ryan, okay, so you typed that. Very good. That's Ryan's contact information.